Before we dive in, please remember that I am not a licensed financial advisor or insurance agent. The information provided in this video is for educational and informational purposes only and should not be considered financial or legal advice. You should always consult with a qualified professional before making any decisions about your insurance coverage. You know that feeling? That envelope arrives in the mail, the one with the little clear window showing your insurance company's logo. Your car insurance renewal. You open it and your stomach does a little flip. The price went up. Again. You haven't had an accident, you haven't gotten a single ticket, your car is a year older and worth less, but somehow you're expected to pay more. So you sigh, you grumble, maybe you vent to your spouse and then you pay it. Because the alternative is just too much of a hassle, right? Well, that sigh, that decision to just pay it and move on, is costing the average American driver over $400 every single year. That's not a guess, that's based on hard data. $400. That's a new set of tires. It's a weekend getaway. It's a significant chunk of your holiday shopping budget, just vanishing into thin air because of a system that is deliberately designed to profit from your inaction. This isn't an accident. It's a business strategy. It's often called a loyalty tax. It sounds crazy, but insurance companies have mountains of data showing that the longer you stay with them, the less likely you are to shop around. They know you're busy. They know you'd rather be doing literally anything else than sitting on the phone, getting insurance quotes. So year after year, they nudge your premium up. A little bit here, a little bit there. It's just small enough that you'll complain, but not so big that you'll go through the monumental pain of switching. They are banking on your inertia. And for decades, it worked beautifully for them. Think about the old way of doing this. If you actually decided to fight back, what was your plan? You'd have to pull out the yellow pages or search online for insurance agents near me. You'd spend your entire lunch break on the phone, answering the same questions over and over again. What's your address? What's the VIN number? Any accidents in the last 3 years? What's your date of birth? You'd give your email and phone number to 5 different companies, unleashing a tidal wave of spam calls and emails that would last for weeks. You'd get 5 different quotes with 5 different coverage levels, making it nearly impossible to do a true apples-to-apples comparison. It was a confusing, time-consuming, and deeply frustrating process. The system was broken and everyone knew it. But then the internet did what the internet does best. Created a better way. It created a tool that could flip the entire power dynamic on its head. Imagine a place where you could enter your information just once, one time, and within minutes, see real, concrete quotes from dozens of different insurance companies, all laid out side by side. No more repeating yourself. No more endless phone calls. Just clarity. That is the promise of insurance comparison websites. And today we are pulling back the curtain on exactly how they work. We're going to demystify the technology, expose the business model, and give you a bulletproof strategy to make sure you are never, ever overpaying for car insurance again. To do this, we're going to focus on one of the biggest and most recognizable players in the game. The Zebra. You've probably seen their commercials. They call themselves the kayak of car insurance. And that's a pretty good analogy. For millions of Americans, they have become the go-to starting point for finding a better deal. But this raises some huge questions. How is this even possible? How can a single website instantly connect with giants like Progressive, Allstate, and 100 smaller carriers to pull your real rate in real time? How is it free? If you're not paying for the service, what's the catch? Because there's always a catch, right? How did they make their money? And the most important question of all, can you actually trust them with your personal information? Is it safe? These are the questions we are going to answer. This isn't just a review of a website. This is a deep dive into the hidden machinery of the modern insurance industry. We're going to explore the technology that makes it all possible, the complex web of data partnerships and algorithms that power these platforms. We'll break down their business model step by step, so you understand exactly how and when they get paid. We'll look at the pros, the massive savings and convenience, and we will not shy away from the cons, including the potential pitfalls you absolutely need to be aware of. By the end of this, you won't just know that these sites can save you money. You will understand how they do it, giving you the power and the confidence to take control of your insurance costs once and for all. You'll be able to walk away with a clear, actionable plan that could put that $400 back in your pocket, where it belongs. So, where does the magic begin? How does filling out one simple form on a website trigger a massive industry-spanning search for the best possible price on your car insurance? It feels like it happens in an instant, But behind that simple Get Quotes button is a sophisticated technological dance. It all starts with the information you provide. Your age, your car, your driving history. This is the raw data. But data is useless unless you can send it to the people who need it, the insurance carriers themselves. And to do that, these websites rely on a powerful, invisible messenger that forms the backbone of the modern internet. It's the key that unlocks the door to every major insurance company's internal quoting engine, and understanding it is the first step to understanding this entire system. So, let's talk about this messenger. In the world of tech, it has a name. An API, which stands for Application Programming Interface. But forget the jargon. Thinking of it as an interface is like calling a master chef a food preparer. It's technically true, but it misses the magic, the artistry, and the sheer power of what's happening. A better way to think of an API is as a universal translator and a hyper-efficient waiter, all rolled into one. Imagine you walk into a massive international food court. There are dozens of kitchens, a Japanese sushi bar, an Italian pasta station, a Mexican taqueria, and a classic American burger joint. Each kitchen represents a different insurance company: Geico, Progressive, Allstate, you name it. They all speak different languages, have different secret recipes, and use different ingredients. Now you could go to each kitchen one by one. You'd have to learn a little bit of their language, figure out their unique menu, place your order, wait, get your food, and then move on to the next one. It would take hours. You'd be repeating yourself constantly. Yes, I'm still 35. Yes, I still drive a 2022 Honda Civic. No, still no speeding tickets. It's exhausting just thinking about it. This is what shopping for insurance used to be like. But with a comparison site like the Zebra, you don't go to the individual kitchens. You sit at one central table, and a single incredibly sophisticated waiter comes to you. This waiter is the API. You give this waiter your order just once. You tell them everything they need to know. Your age, your car, your driving history, the coverage you want. You speak in your own language, simply and clearly. The waiter, the API, doesn't cook the food. This is the most important part to understand. The Zebra doesn't calculate your insurance rates. Instead, the waiter instantly translates your single order into dozens of different languages. It creates a perfect, custom-formatted request for the Japanese kitchen, another for the Italian kitchen, and another for the Mexican kitchen, all simultaneously. It knows exactly how each specific kitchen needs to receive the order to understand it perfectly. Then, in less time than it takes to blink, it sprints to every single kitchen at once and hands them your perfectly translated order. This is the request part of the API call. Your data, encrypted for security, is being sent from the comparison website servers to the insurance company's servers. Now let's follow that order. It arrives at the front door of, say, Progressive's digital kitchen, but this isn't a kitchen with a swinging door. It's a fortress. It has a digital gatekeeper, a bouncer. This gatekeeper is Progressive's own API endpoint. Its job is to check credentials. The first thing it asks is, who are you? The waiter from the Zebra presents its credentials, a unique secret key that says, I'm a trusted partner. I'm allowed to be here. If a random, untrusted app tried to ask for a quote, the bouncer would throw it out immediately. This is a critical security measure. It ensures that only legitimate, vetted partners can request information, protecting both the insurance company and you, the consumer. Once our waiter is verified, the gatekeeper inspects the order itself. Is this formatted correctly? Does it have all the information I need? Is the address valid? Is the vehicle identification number the right number of digits? It's a strict quality control check. If anything is missing or wrong, the order is rejected and sent back with an error message. This is why filling out the form accurately is so important. A single typo can cause the entire request to one insurer to fail. Assuming the order is perfect, the gatekeeper accepts it and allows it inside the fortress. This is where your information passes from the public-facing internet into the insurance company's private, internal brain. This is the black box where the real magic and the math happens. Inside this black box are the company's underwriting algorithms. These are the secret recipes. This is the culmination of decades of data, actuarial science, risk assessment models, and complex business strategies. The system takes your information, your age, your location, your car's safety rating, your driving record, and starts running it through a labyrinth of calculations. It cross-references your data with enormous databases. It checks your driving history for accidents or violations. In some states, it might perform a soft pull on your credit to generate an insurance score. which is different from your regular credit score. It analyzes local weather patterns, theft rates for your specific car model in your specific zip code, average repair costs, medical costs in your area. Thousands of data points are being analyzed in a fraction of a second. Each company's secret recipe is different. One company might weigh your age more heavily. Another might be more concerned with the exact model of your car. A third might offer a huge discount for a perfectly clean driving record that others don't. This is why your quote can be wildly different from one carrier to the next. They are all using the same ingredients, your data, but they are following vastly different recipes. After this incredibly complex calculation is complete, the result is produced, a price. Your premium. But it's not just a number. It's a full quote, detailing the exact coverage for that price, bodily injury liability, collision, comprehensive, all packaged up. Now the process reverses. The finished dish, your personalized quote, is handed back to our waiter, the API. The API takes this package, which is formatted in Progressive's unique language, and instantly translates it back into a standardized format that the Zebra's website can understand. Remember, this entire process, the verification, the internal calculation, the packaging of the quote, and the return trip, happened in a sliver of a second. And it wasn't just happening at Progressive. It was happening at the same time at Allstate, Travelers, Nationwide, and dozens of other insurance companies that have partnered with the comparison site. Dozens of waiters, all dispatched from your single order, are all returning to your table at virtually the same moment, each carrying a different dish from a different kitchen. The final step happens back on the comparison site itself. The website is now holding dozens of quotes, all translated back into a single uniform language. Its job is to be the ultimate menu. It takes all these different options and lays them out for you in a clean, simple, easy-to-compare grid. It strips away the confusing jargon and shows you what matters: the price, the coverage, the carrier. What you see as a simple loading bar, followed by a list of prices, is actually the grand finale of a breathtakingly complex and rapid-fire digital symphony. It's a journey that takes your data on a secure, encrypted round-trip flight to the inner sanctums of the country's largest financial institutions and back, all before you can take your next breath. The API is the hero of this story. It's the connective tissue of the modern insurance marketplace. It turns a process that used to take days of phone calls and frustration into a matter of seconds. It's not just a tool. It's the fundamental innovation that makes instant, multi-carrier comparison possible. So now we understand the how. We know the path your data takes. But that just raises an even more important question. We've seen it go into the black box, into that secret kitchen where the recipe is hidden. What exactly are they looking for in there? What are those secret ingredients, those risk factors, that can cause your quote to double or get cut in half? Because it's not just about your driving record. There are factors at play you've probably never even considered, and they have a massive impact on the price you pay. And understanding them, that's the key to truly taking control. So let's start with the biggest one, the factor that makes people's jaws drop when they first hear about it. It has absolutely nothing to do with how you drive. It has everything to do with how you handle your money. I'm talking about your credit score. Yes, your credit score. In every single state except for California, Hawaii, Massachusetts, and Michigan, insurance companies are legally allowed to use a credit-based insurance score to help determine your premium. Now, this isn't your FICO score exactly. It's a specialized version, a secret recipe cooked up by the insurance industry, but it's heavily influenced by your regular credit report. Why? What on earth does your Visa bill have to do with whether you'll run a red light? To the insurance companies, it's all about correlation. Decades of data analysis have shown them a strong statistical link between how people manage their finances and how likely they are to file a claim. The logic, from their perspective, goes something like this. A person with a high credit score is seen as more responsible, more likely to perform regular maintenance on their car, and more likely to be financially stable enough to handle a small fender bender out of pocket instead of filing a claim. Conversely, someone with a lower score might be seen as more likely to take risks, perhaps deferring important car maintenance, and more likely to file a claim for even minor damage because they don't have the cash on hand. Is it fair? That's a fierce debate. Consumer advocates argue it penalizes people for life events beyond their control, like a medical emergency, a job loss, or a divorce, that can temporarily tank a credit score. But for the insurance algorithm, you are not a person with a story. You are a data point, a number, and a lower credit score flags you as a higher risk, which means a higher premium. We're talking a massive difference. A driver with poor credit can pay, on average, More than double what an identical driver with excellent credit pays for the exact same coverage. Double. For a factor that has nothing to do with their actions behind the wheel. But it gets even more personal. Where do you park your car at night? I'm not asking if it's in a garage or on the street. I'm asking, what is your zip code? Because your address, your literal dot on the map, is one of the most powerful factors in your insurance rate. Insurers call this your garaging location. You might be the safest driver in the world, but if you live in a zip code with a high rate of auto theft, vandalism, or insurance fraud, your rates are going up. If your neighborhood has more traffic congestion, narrower streets, or a higher frequency of accidents, your rates are going up. If you live in an area prone to severe weather like hail, hurricanes, or flooding, you guessed it, your rates are going up. You are being judged by the company you keep, not just your friends but your neighbors. Think about two identical people, same age, same car, same driving record, same credit score. One lives in a quiet rural town. The other lives in the heart of a bustling city like Los Angeles or Miami. The city dweller will pay astronomically more, simply because the statistical risk associated with their 5-digit zip code is higher. They could have their car locked in a secure underground garage 23 hours a day. It doesn't matter. The algorithm sees the zip code and adjusts the price accordingly. It's a stark reminder that auto insurance isn't just about your risk. It's about the pooled risk of everyone around you. Okay, so we have your credit in your location. What about the car itself? This seems obvious, right? A flashy red sports car costs more to insure than a boring beige sedan. And yes, that's true, but the reasons are far more nuanced than just speed. The algorithm is looking at a vehicle's entire profile. First, what is the cost to repair it? A luxury import with specialized aluminum body panels and a dozen sensors in the bumper is going to cost a fortune to fix after a minor collision compared to a domestic pickup truck. The insurance company knows the average repair bill for every single make and model, down to the trim level. Second, what is its theft rate? This is a huge one right now. You've probably heard about the viral social media trend targeting certain Kia and Hyundai models. Because of a design flaw, they are incredibly easy to steal. As a result, the theft rates for these cars have skyrocketed, and so have their insurance premiums. Some owners have seen their rates triple or have been dropped by their insurer entirely, through no fault of their own. It doesn't matter that you're a responsible owner who installed an extra anti-theft device. The data for that model is now radioactive, and everyone who owns one pays the price. Third, what are its safety ratings? But here's the twist. It's not just about how well the car protects you in a crash. The algorithm is also looking at how much damage your car is likely to inflict on other cars and their occupants. A massive heavy-duty truck might be incredibly safe for the driver, but in a collision with a small compact car, it's going to cause a catastrophic amount of damage and potential injury. That represents a huge potential payout for the insurance company's liability coverage. So, ironically, some of the safest cars for the driver can actually carry higher insurance premiums because of the risk they pose to others on the road. And it doesn't stop there. The algorithm wants to know about you, the person. Are you married? Statistically, married people get into fewer accidents than single people. Insurers see marriage as a sign of stability and responsibility. So if you're married, you'll likely get a discount. Do you own a home? Homeowners are also considered more stable and less risky than renters, earning them a lower premium. Your level of education, your occupation, in some states these can be used as well. A software engineer with a master's degree is considered a lower risk than a delivery driver with a high school diploma. Each of these data points is a tiny input into a vast, complex pricing engine, and they all layer on top of each other. Think about it. You could be a 40-year-old woman with a perfect 25-year driving record. Not a single ticket, not a single accident. But maybe you went through a tough divorce last year, and your credit score took a hit. You just moved to a new apartment in a denser part of town to be closer to your new job. And you drive a popular SUV model that, unbeknownst to you, has become a target for catalytic converter theft in your new area. Suddenly, your perfect driving record is almost irrelevant. The algorithm sees lower credit score, riskier zip code, high theft vehicle. Your renewal quote comes in, and it's 50% higher than last year. You haven't changed how you drive at all, but your risk profile, in the cold, calculating eyes of the insurer, has completely transformed. This is the hidden world of insurance pricing. It's a mosaic of data points, a profile built from your financial history, your geography, your demographics, and your vehicle statistics, long before your actual driving habits are even considered. Feels like a black box. You pour your personal information into one end, and a mysterious number comes out the other. Which raises the most important question of all. How? How do they know all of this? How does a single website, in a matter of seconds, pull your credit information, verify your address history, analyze the crime statistics in your neighborhood, and access the detailed loss history for your specific car? They aren't just guessing. They are plugging into a massive, invisible ecosystem of data that tracks, catalogs, and scores nearly every aspect of our lives. And understanding that system, that's the next piece of the puzzle. So let's open up that puzzle box. The first piece looks deceptively simple. It's the information you willingly hand over. When you land on a site like the Zebra, you type in your name, your address, your date of birth, and the make and model of your car. To you, it feels like filling out a form. To the system, you've just handed it a set of keys. Each piece of information, your zip code, your age, your vehicle identification number, or VIN, isn't just a data point. It's a key that unlocks a specific door in a vast, digital labyrinth of information about you. Your name and driver's license number? That's the key to the Department of Motor Vehicles. Instantly, the system sends out a request, a digital ping, to your state's DMV database to pull your motor vehicle report, or MVR. This isn't a maybe. It's a fundamental step. The MVR is the official story of your life as a driver. It lists every speeding ticket that stuck, every fender bender you were found at fault for, every license suspension, every point on your license. It's the unvarnished truth, straight from the source. If you told the website you have a clean record, but your MVR shows a speeding ticket from 8 months ago, the system knows. There's no hiding. Your address? That's not just about where you park your car at night. It's a key that unlocks a world of geographic and demographic data. The system instantly cross-references your zip code with immense databases that track weather patterns, crime rates, and traffic density. Does your area have a high rate of auto theft? Is it prone to hailstorms or flooding? Are the roads congested, leading to more accidents? Your personal driving skill becomes just one factor in a much larger equation of neighborhood risk. You could be the safest driver in the world, but if you park your car on a street where 3 cars were broken into last month, your perceived risk and your premium goes up. But these are the obvious doors. The DMV local crime stats, we can sort of wrap our heads around that. The real magic, the part that feels like it's straight out of a science fiction movie, happens when the system uses your information to unlock the doors to private data brokers. These are companies you've probably never heard of, but they've definitely heard of you. Companies like LexisNexis Risk Solutions and Verisk Analytics. These aren't your average credit bureaus like Experian or Equifax. They are data giants. They operate in the shadows of the financial world, and their sole purpose is to collect, collate, and sell information about risk. They are the insurance industry's private investigators. They pull data from thousands of sources: court records, property records, credit information, and most importantly, from the insurance companies themselves. Let's focus on LexisNexis for a second. They manage a colossal database called the CLUE report. CLUE stands for Comprehensive Loss Underwriting Exchange. Think of it as a secret credit report just for your insurance history. For the last 7 years, every single auto insurance claim you filed is logged in this database. Did you call your insurer because a tree branch fell on your car? Even if you didn't get a payout? It's in the report. Did you inquire about a potential claim after a minor parking lot bump, but decided not to go through with it? The inquiry itself can be logged. When you use a comparison site, it pings the CLUE database. It's looking for the story you didn't tell. It sees the claim you filed 3 years ago for that rear-end collision you forgot about. It sees the water damage claim from that freak storm 2 years prior. This report creates a pattern of your behavior as an insurance customer. Are you someone who files a lot of claims? Even for small things? To an insurer, that pattern screams high risk. It means you're more likely to cost them money in the future, regardless of your driving record. And here's the kicker. You have a right to see your own CLUE report, just like a credit report. Most people don't even know it exists. And it's not just about you. Remember the vehicle identification number, the VIN? That 17-digit code stamped on your dashboard is the key to your car's entire life story. The system pings databases like Carfax or AutoCheck. It's looking for the car's secret history. Has it ever been in a major accident? Was it ever declared a total loss and given a salvage title? Was the odometer ever rolled back? A car with a serious accident history, even if it's been perfectly repaired, is seen as a higher risk. Its structural integrity might be compromised. its safety features might not deploy as designed in a future crash. So a car with a clean title versus one with a salvage title, even if they look identical on the outside, will have wildly different insurance rates. The system knows the difference in seconds. So now let's take a step back and look at what's happened in the few seconds since you clicked Get Quotes. The system has taken your basic information and used it as a master key. It's unlocked the official government record of your driving history from the DMV. It's unlocked the geographic risk profile of your neighborhood. It's unlocked your secret insurance history from private data brokers like LexisNexis. And it's unlocked the complete, unabridged biography of your vehicle through its VIN. What you have now is not just a collection of random facts. You have a multi-dimensional, data-rich portrait of risk. It's a mosaic built from dozens of different sources, all coming together to create a single unified profile. A comparison website like the Zebra doesn't just pass your information along. Its first and most critical job is to be a master assembler. It gathers all of these disparate pieces of your puzzle: the MVR, the CLUE report, the vehicle history, the location data, and puts them together. It creates a standardized digital file, a comprehensive risk profile that essentially scores you and your vehicle. This profile is the product. It's the you that the insurance companies will actually see. And this is a crucial point. Every insurance company speaks a slightly different language. They weigh factors differently. Geico might be terrified of a speeding ticket, while Progressive might care more about a previous claim. They have their own secret algorithms, their own internal black boxes for calculating a final price. The comparison site's job is to act as a universal translator. It takes the comprehensive profile it just built and formats it in a way that can be fed directly into the hungry mouths of hundreds of different insurance algorithms simultaneously. It sends out this perfectly packaged bundle of data and says, here is the applicant. Here is their car. Here is their complete history. Based on your specific rules, what is your absolute best price? The process feels instantaneous to you, but behind the curtain, it's a frantic, high-speed data exchange of staggering complexity. It's a symphony of requests and responses, happening at the speed of light. And the quotes that come flooding back to your screen aren't just guesses. They are firm, bindable offers based on a deeply detailed, verified, and cross-referenced understanding of who you are as a risk. But this raises the next big question. Once the insurance companies get this data, what exactly do they do with it? How does their black box actually turn your risk profile into a price? It's a field called actuarial science. And while it sounds complex, the core idea is simple: using statistics and historical data to predict the future. Specifically, to predict the likelihood that you will cost the insurance company money. Every single piece of data they collect about you is fed into a sophisticated pricing engine, an algorithm that performs a two-step calculation. First, the insurer establishes a base rate. Think of this as the starting price. This rate is determined for a hypothetical perfect driver, someone with a flawless record, a standard safe car, and ideal characteristics, living in a specific geographic area, usually defined by a zip code. This base rate already accounts for broad, location-specific risks. For example, the base rate in rural Wyoming, with its wide-open roads and low traffic density, is going to be fundamentally lower than the base rate in Brooklyn, New York, where the risk of a fender bender, theft, or hitting a pedestrian is statistically much higher. This base rate is the canvas. Your personal information is the paint. Second, the algorithm applies a series of multipliers and discounts to that base rate, based on your individual risk profile. Each piece of information you provide either adds a little bit to the cost or subtracts a little bit. It's a delicate dance of numbers, and this is where the magic and the mystery truly happens. Let's break down the biggest multipliers. The most powerful one, right after your location, is your driving record. This is the most direct evidence of your risk. A clean record with no accidents or violations for the past 3 to 5 years gets you the biggest discounts. It tells the insurer you are a proven safe driver. But start adding violations and the multipliers kick in hard. A speeding ticket might increase your rate by 10 to 20%. A more serious offense like a DUI is a massive red flag. It can double or even triple your premium overnight, or cause an insurer to drop you altogether, because it signals extremely high-risk behavior. At-fault accidents are just as damaging. The insurer had to pay out a claim because of you, and they will adjust your price to reflect the high probability that they'll have to do it again. Next up is the car you drive. Insurers look at a vehicle's specific history across millions of drivers. They know down to the dollar the average claim cost for a 2022 Ford F-150 versus a 2018 Toyota Camry. This isn't just about the car's sticker price. It's about 4 key things. 1. The cost of repair. A minor dent in a Honda Civic might cost a few $100s to fix. The same dent in a brand new Audi with advanced sensors in its bumper could cost thousands. 2. Safety ratings. Cars with high crash test ratings and modern safety features, like automatic emergency braking, get discounts because those features are proven to prevent accidents and reduce injuries, saving the insurer money. 3. Theft rates. Some cars are just more popular with thieves. If you drive a model that's frequently stolen, your comprehensive coverage rate will be higher. And 4. Performance. A 400 horsepower sports car is, statistically speaking, more likely to be involved in a high-speed accident than a family minivan. The algorithm prices that risk accordingly. Then we get to the more personal and sometimes controversial factors. Your age and marital status. The data is ruthless and unwavering on this point. Young drivers, particularly single males under the age of 25, have the highest accident rates of any demographic. It's not a judgment on their character. It's a cold, hard statistical reality borne out over decades of data. As a result, they face the highest premiums. Rates typically start to drop significantly around age 25, and continue to decrease into your 50s and 60s, assuming a clean record. Being married also provides a small discount, as statistics show that married individuals tend to file fewer claims than their single counterparts. And now for the one that surprises most people: your credit-based insurance score. This is not the same as your FICO score, but it's derived from similar information in your credit report. Insurers are adamant about this. Decades of their internal data show a powerful, undeniable correlation between how a person manages their financial responsibilities and how responsibly they drive. The theory is that someone who is diligent about paying their bills on time and managing their debt is also more likely to be diligent about maintaining their car and obeying traffic laws. It's one of the most predictive factors they have. A person with excellent credit can pay up to 50% less than an identical driver with poor credit. It's a huge multiplier, and it's one that operates completely behind the scenes. Finally, there are the choices you make yourself, your coverage levels and deductibles. This is simple math for the insurer. If you choose state minimum liability coverage, their potential payout is capped at a relatively low amount. If you choose high liability limits, add comprehensive and collision coverage, and opt for a low deductible of, say, $250, you are transferring a massive amount of potential financial risk to them. Your premium will be higher because their potential exposure is higher. So the black box takes the base rate for your zip code and then starts multiplying. It sees a 28-year-old married man. Discount. Driving a safe, reliable sedan. Discount. With a clean driving record. Big discount. Excellent credit. Huge discount. Then it adds on the cost for the high coverage levels he selected. The final number that pops out is the premium. But here's the most critical piece of the puzzle: the reason why your quote from Progressive is totally different from your quote from Geico, even with the exact same information. Each company has its own secret algorithm. They all use the same basic ingredients: driving record, car, credit, age, but they use a different recipe. One company might have data showing that drivers of Subaru Outbacks in the Pacific Northwest are exceptionally safe, so they offer a massive discount for that specific combination. Another company might be trying to attract more customers with perfect credit, so they program their algorithm to weigh that factor more heavily than anyone else. A third company might have had a bad year with claims from young drivers, so they crank up the multiplier for anyone under 25 to discourage them from signing up. This is the entire game. It's not about finding the one best insurance company. It's about finding the company whose secret proprietary algorithm is most favorable to your specific, unique combination of risk factors. You could be a high-risk driver in one company's eyes and a preferred customer in another's. You will never know what their internal recipe is. The only way to find out is to run your numbers through all of their black boxes at once. This is the problem that comparison sites like the Zebra were built to solve. They don't have their own price. They are a master key, designed to unlock all of those different black boxes simultaneously. When you enter your information once, their technology is plugging it into dozens of these unique pricing engines, letting them all run their secret calculations, and then simply showing you the results from lowest to highest. It's a brute force approach to cracking a complex and opaque system. It reveals which company's algorithm loves you the most. But it also brings up a darker question. We've talked about all the factors they use to calculate your price. What about the factors they don't use? Or, more importantly, the ones they are legally forbidden from using? And how do we know they're actually following the rules? That question of what's not allowed is where the entire system of insurance fairness is supposed to be anchored. And the number one, most important, federally protected factor that can never be used to set your car insurance price is your race. Period. Full stop. It is explicitly and completely illegal under federal law, stemming from the Civil Rights Act of 1964.
Noif en hors but.
An insurer cannot look at a black driver and a white driver with identical records, cars, and addresses, and charge them a different price. The same goes for your religion, your national origin, or the color of your skin. These are what are known as protected classes, and they are the third rail of insurance pricing. Touch it and your company is finished. But that leads directly to the second, more cynical question. How do we know they're really not using it? How do we know it's not baked into some secret part of the algorithm? This is where the system of oversight comes in, and it's a part of the insurance world that almost nobody knows about. You see, an insurance company can't just invent a price and start selling policies. They can't just wake up one morning and decide that people who drive red cars should pay 10% more. Every single rule, every factor, every discount, every surcharge, every single piece of the mathematical puzzle that determines your final price has to be submitted, reviewed, and officially approved by a government body in every single state where they operate. This body is usually called the Department of Insurance, or DOI. Think of them as the insurance police. Their job is to protect consumers. When Geico or Progressive creates a new rating plan, they have to send thousands of pages of documentation to the DOI, justifying every single decision with massive amounts of data. They have to prove, to the satisfaction of state regulators and statisticians, that their factors are what's called actuarially sound. That's the magic phrase. It means they have to show a direct, provable statistical correlation between a factor and the risk of a future claim. If they can't prove it with data, the DOI will reject it and they can't use it. This is the first line of defense. It's a massive bureaucratic and frankly slow-moving process that prevents insurers from just making things up. They are legally required to open up their black box, at least to the regulators, and prove their math. So race, religion, national origin, those are off the table. But this is where the water gets incredibly murky, because there are a handful of factors that feel like they should be illegal, that feel unfair, but which in most states have been deemed actuarially sound and are therefore perfectly legal to use. Let's start with the big one: your credit score. For a lot of people, hearing that their credit history affects their car insurance bill feels like a punch to the gut. What does my Visa bill have to do with my driving? It feels like a way to penalize people for being poor, not for being bad drivers. And that criticism is not without merit. But insurers have successfully argued, with decades of data, that there is a bizarrely strong correlation between a person's credit score and the likelihood they will file a claim. They don't claim to know why. They're not saying people with bad credit are bad people. They just point to the numbers. The data shows that, as a group, people with lower credit scores file more claims, and more expensive claims, than people with higher credit scores. And because they can prove that statistical link, most state regulators have allowed it. It's considered actuarially sound. Now, is it fair? That's a massive debate. And some states have agreed that it isn't. California, Hawaii, and Massachusetts have banned the use of credit scores in setting auto insurance rates. But in the other 47 states, it's fair game, and it can have a colossal impact on your premium. Next up is another controversial one: gender. For years, it was an accepted fact of insurance that young men paid astronomically more than young women. The data was overwhelming. Teenage boys and men in their early 20s get into far more frequent and severe accidents than their female counterparts. Actuarially, it was a slam dunk. But over time, society and regulators started to question whether it was fair to penalize an entire gender for the actions of its riskiest members. As a result, a growing number of states have banned the use of gender in rate setting. California, Hawaii, Massachusetts, Michigan, North Carolina, and Pennsylvania have all said no more. In those states, a 20-year-old male and a 20-year-old female with identical profiles will be quoted the exact same price. But everywhere else, gender is still on the table. And then there are the factors you probably never even knew were being used. Things like your level of education and your occupation. That's right. In many states, having a master's degree can get you a cheaper rate than having a high school diploma. Being an engineer or a teacher can get you a better price than being a construction worker or a chef. Again, the insurance companies have presented data to regulators suggesting that people in certain professions, or with higher educational attainment, are as a group, statistically less likely to file claims. Feels classist. Feels like a proxy for income. But because the correlation exists in the data, it's often approved. This brings us back to that crucial question of enforcement and fairness. Even if an insurer isn't directly using race, could they be using other factors that have the same effect? This is the concept of disparate impact. For example, we know that due to decades of systemic issues, certain zip codes are predominantly inhabited by minority groups. We also know that zip codes are a huge factor in insurance pricing. So, if an insurer heavily penalizes a specific zip code, are they indirectly discriminating based on race, even if they aren't doing it intentionally? This is one of the most complex and important challenges facing regulators today. The algorithms are getting smarter and more complex, using dozens or even hundreds of variables. It's becoming harder and harder to untangle the web and ensure that these complex calculations don't end up reinforcing old biases. Regulators are actively working on new tools and new statistical tests to audit these algorithms for disparate impact, but it's a technological arms race. So, where do comparison sites like the Zebra fit into this picture of rules and regulations? It's simple. They are a window into this regulated marketplace. When you enter your information on the Zebra, it doesn't create its own prices. It securely passes your information through an API to each of its partner insurance companies, let's say Progressive, Allstate, and Travelers. Each of those companies then runs your information through their own state-approved rating engine. The price that comes back is the exact same price you would get if you had called that company on the phone or gone to their website directly. The Zebra, or any comparison site, has no ability to show you an illegal rate, because those rates literally don't exist within the insurance company's approved systems. They are simply a portal that lets you access all of these heavily regulated, government-audited prices in one place. Their value isn't in changing the rules. It's in providing transparency within the rules. It lets you see in plain daylight how one company might penalize your credit score more than another, or how another might give a bigger discount for your clean driving record. It exposes the strange quirks and priorities of each company's state-approved algorithm. So the system, for all its flaws, has checks and balances. It has federal laws, state-level police in the form of the DOI, and a requirement for everything to be backed up by data. But all of this was designed for a world of statistics based on demographics and driving records. Now we're entering a brand new era. An era where the data isn't just about who you are, but about how you actually drive. I'm talking about telematics, the little plug-in devices or smartphone apps that track your every move behind the wheel. Your speed, your braking, the time of day you drive, the routes you take. This isn't a statistical proxy for risk anymore. It's a direct observation of it. And it's blowing up the old rulebook. What happens when your car is its own black box, reporting your every mistake directly back to the insurer? Is that the fairest system possible, or is it a privacy nightmare? The answer, uncomfortably, is both. It's the fairest system ever devised, and it's a privacy nightmare of Orwellian proportions, all at the same time. Let's start with fairness. For a century, insurers have been playing a guessing game. They look at your age, your gender, your zip code, your credit score, and they make an educated guess about how you'll drive. It's a game of proxies, of stereotypes. A 22-year-old male living in a dense urban area? Statistically, a massive risk. He pays a fortune even if he drives like a saint. A 50-year-old woman in a quiet suburb? A safe bet. She gets a discount even if she drives like a maniac. It's not personal. It's just math based on large impersonal data sets. Telematics, or what the industry calls usage-based insurance, promises to change all that. It says, we don't care about the stereotypes. We only care about one thing: how you actually drive. It's the ultimate meritocracy. Your premium is based on your actions, not your demographics. If you accelerate smoothly, brake gently, obey speed limits, and avoid late-night driving, your rate plummets. It doesn't matter if you live in a zip code with the highest accident rate in the state. The data from your car proves you are a good risk. Finally, the individual is seen for who they are, not what group they belong to. For millions of safe drivers trapped in high-risk categories, this is liberation. It's the end of paying for the sins of others. It's the promise of a truly personalized, truly fair price. But that's only one side of the coin. The other side is dark. To achieve this perfect fairness, you have to surrender your privacy on a scale we've never seen before. We're not just talking about hard brakes and fast turns. The little black box or the app on your phone is collecting everything. It knows the second you leave your house and the second you return. It knows you went to the grocery store on Tuesday, the gym on Wednesday, and a bar on Friday night. It knows you stayed at that bar until 2 in the morning. It knows you then drove home. The algorithm doesn't judge you for it, not in a human way. It just notes. Driver engages in late-night activity, statistically correlated with higher instances of fatigue and impaired driving. Risk score adjusted up by 3.7%. It knows you drove through a neighborhood the system has flagged as high crime. It doesn't know you were visiting your grandmother. Just knows you were there. Risk score up. It knows your commute to your new job is 20 miles longer than your old one. More time on the road equals more exposure to risk. Score up. This data paints an intimate portrait of your life. Your habits, your routines, your social life, your financial struggles. And you are handing this portrait over to a for-profit corporation in exchange for a potential discount. And this is where insurance comparison websites like the Zebra re-enter the picture, but in a completely new role. Their original purpose was to demystify a complex market, to take a blurry landscape of 100 different insurers and bring it into sharp focus, letting you compare on price. But with the rise of telematics, the most important thing to compare is no longer just the price. It's the privacy policy. It's the data sharing agreement. When you go on the Zebra and see a quote from Progressive that's $200 cheaper, is it because they're offering a standard policy? Or is it because that rock bottom price is contingent on you installing their snapshot device? Does the site make that distinction crystal clear? Are you comparing apples to apples? Or are you comparing a traditional insurance policy to a surveillance contract? The comparison site now sits at a critical junction. It can either be a simple price engine, luring you in with the cheapest possible number, regardless of the hidden cost to your privacy, or it can become an essential consumer advocate, a privacy navigator. It could have filters. Show me quotes that do not require telematics. Or detailed, easy-to-read summaries. Warning. This insurer's telematics program tracks your precise location 24/7 and reserves the right to share anonymized data with third-party marketers. The problem is that level of transparency can be bad for business. The business of a lead gen site is to generate a lead to get you to click to get your information to the insurer. The lower the price, the higher the click-through rate. And the absolute lowest prices will almost always come with the telematics-based strings attached. So there's a fundamental conflict of interest. Does the comparison site serve the user by providing total clarity, even if it makes the prices look less attractive? Or does it serve its insurance partners and its own bottom line by keeping things a little vague, focusing on that dazzlingly low number and hoping you don't read the fine print until it's too late? This dilemma gets even more complicated when we consider the algorithms themselves. We assume that data is objective, that a computer looking at your driving habits is inherently fairer than a human underwriter looking at your zip code. But that's a dangerous assumption. Algorithms are written by people, and they are trained on historical data, and that data is filled with the biases of the real world. Let's imagine a scenario. A single mother works 2 jobs to make ends meet. One is a day shift at a hospital, the other is a night shift cleaning offices. She drives home at 3 in the morning. The telematics algorithm sees this and flags it. Late night driving. High risk. Her rates go up. Another person, a gig worker, has to drive all over the city, often through heavily congested, lower-income neighborhoods where fender benders are more common. The algorithm sees this. Frequent driving in high accident zones. High risk. Their rates go up. In both cases, the algorithm isn't being malicious. It's just doing what it was programmed to do. Identify statistical risk based on the data it's given. But the outcome is a system that can systematically penalize people for the circumstances of their economic reality. It's a high-tech version of redlining. It's not based on your race or your neighborhood anymore. It's based on a data-driven pattern of life that is inextricably linked to your socioeconomic status. Is that fair? The data says you are a higher risk, but the context, the why behind the data, is completely lost. You're not a reckless driver. You're just trying to survive. But the algorithm doesn't see the difference. And what happens to this treasure trove of data? Insurers say it's secure, that it's anonymized. But we've heard that story before from every tech company in Silicon Valley, right before a massive data breach. Imagine a world where your minute-by-minute driving history is hacked and dumped on the dark web. Or not even hacked but sold. Sold to city planners to identify traffic patterns. Sold to fast food chains to decide where to build their next drive-through. Sold to lawyers in a divorce case to prove infidelity. Sold to law enforcement without a warrant. The line between a discount and total surveillance is razor thin. And the companies that stand in the middle, the aggregators, the comparison websites, hold immense power. They are the gatekeepers. They frame the choice. They decide what information to highlight and what to bury. They are shaping the future of this industry, pushing us toward a world of perfect pricing and zero privacy, one click at a time. The question of how they make their money, what their real business model is, becomes more important than ever. Because when a service is free, and it's helping you navigate a multi-billion-dollar industry, you're not the customer. You are the product. So what exactly are they selling and to whom? And how much is your data, your privacy truly worth in their marketplace? The marketplace is you. Your data, your digital ghost, is the commodity being bought and sold in a lightning-fast, invisible auction you never even knew you were a part of. When you fill out that form, your age, your car, your driving history, your address, you're not just requesting a quote. You are minting a fresh piece of digital currency. And in the world of insurance, that currency is called a lead. A lead is the lifeblood of the entire sales industry. For an insurance agent sitting in an office in Omaha, Nebraska, or a call center in Tampa, Florida, a steady stream of good leads is the difference between making rent and buying a new boat. And comparison websites are the biggest, most efficient lead factories ever created. Here's how the factory line works. The moment you click that Get My Quotes button, your information is packaged up. It's analyzed, scored for quality, and then, in many cases, put up for sale. This isn't like selling a used car on Craigslist. This is a high-frequency trading floor. Algorithms instantly offer your lead to a network of buyers, insurance carriers, large agencies, and even individual local agents. The buyers have preset budgets and criteria. They might be looking for married homeowners over 30 with a clean record in Texas, and they're willing to pay, say, $50 for a lead that matches. Another agent might be a specialist in high-risk drivers and is willing to pay $75 for someone with 2 DUIs because they know they can sell a high-premium policy. A frantic, automated bidding war takes place in the milliseconds between your click and the results page loading. The winners of that auction get your information instantly. This is where the user experience, your experience, begins to make a terrifying amount of sense. Ever wondered why after using one of these sites, your phone starts ringing off the hook from numbers you don't recognize? It's because you weren't sold as an exclusive lead. An exclusive lead is the gold standard. It means your information is sold to one, and only one agent or company. They pay a premium for this exclusivity because they don't have to compete. But it's far more profitable for the comparison site to sell your data as a shared lead. A shared lead is exactly what it sounds like. Your packet of information is sold to 3, 5, sometimes even 10 different buyers simultaneously. The website gets to collect a payment from every single one of them. For the site, it's a masterstroke of efficiency. They turn one user into multiple revenue streams. For you, it's a nightmare. It's why you get 5 phone calls and 10 emails in the first hour. Those agents who just paid good money for your name know they are in a race. The first one to get you on the phone and close the deal wins. The others just wasted their money. This system inherently creates the aggressive, high-pressure sales environment that everyone hates. It's not a bug, it's the feature. And it doesn't stop there. What happens if no one can reach you or you don't buy? Your lead gets a little older, gets downgraded. After a few days or weeks, it might be bundled with thousands of other aged leads and sold in bulk for pennies on the dollar to less reputable call centers or email marketers. This is why you might get a random call about your auto insurance inquiry 3 months after you've already bought a policy. Your ghost is still rattling around the machine, being endlessly resold. To understand why an agent would pay $50, $60, even $100 just for your phone number, you have to understand the concept of lifetime customer value, or LCV. That agent isn't just trying to sell you a 6-month $500 policy. If they sell you that policy, they'll earn a commission, maybe $75. That's a loss on a $100 lead. But they're playing the long game. They know that the average person stays with an auto insurance company for about 5 years. Many stay for 10 or 20. They also know you'll probably bundle your home or renter's insurance. You might add a car or a new teen driver. Over a decade, you, as a customer, could be worth thousands and thousands of dollars in recurring commissions. Suddenly, paying $100 up front to acquire you doesn't just seem reasonable. It seems like an incredible bargain. You are the goose that lays the golden eggs, and they are simply bidding on the goose. So, is this what the zebra is doing? Are they just another lead factory, auctioning off your data to the highest bidders? The answer is no, not exactly. And this distinction is the core of their entire business model and marketing message. The zebra operates not as a lead generator, but as a licensed insurance agency. They are, in legal and practical terms, an insurance broker, just like the independent agent you might find on a main street in your town. This fundamentally changes the flow of money and, therefore, the incentives. When you use a classic lead gen site, the site's primary customer is the insurance agent buying the lead. Their goal is to maximize the revenue from selling your data. When you use the Zebra, their goal is for you to actually buy an insurance policy through them. Because they are a licensed agency, when you select a policy from, say, Progressive or Allstate on their site, the Zebra receives a commission from that carrier. The same commission a traditional agent would receive. Their primary customer is supposed to be you, the consumer. Their incentive is to make the sale happen. This means they have less of a financial reason to sell your data to 10 competing agents in a frantic race to the bottom. It would be counterproductive. They want to be the one to facilitate the sale and collect that lucrative recurring commission. This is why, for the most part, using the Zebra doesn't result in the same immediate flood of spam calls. They are not broadcasting your information. Instead, they are acting as the middleman, the digital agent. They show you the prices, and if you choose to buy, they connect you to the carrier to finalize the policy, or what's known in the industry as binding the policy. Now, is it a perfect system? Of course not. The model is more of a hybrid. In some cases, for certain types of insurance or for customers who require more hands-on help, the Zebra may refer you to a partner agency. This is, for all intents and purposes, a very high-quality exclusive lead. But it's a referral to a single vetted partner, not a blast to a dozen random bidders. The core difference is intent. The intent is to get you a policy, not to sell your contact info as many times as possible. This broker model is the Zebra's key differentiator. It's how they can claim to be on your side, to be an impartial marketplace. They've aligned their financial success with you actually buying a policy you're happy with, rather than with the raw act of selling your privacy. It's a cleaner, more consumer-friendly model. But it relies on a massive, complex, and often invisible system of data. To give you that accurate quote in seconds, they have to pull information about you from sources you've never even heard of. They aren't just taking your word for it that you have a clean driving record. They are checking. They are building a profile of you in real time, pulling in data points that go far beyond your car and your address. And the most important piece of that profile, the one that can swing your insurance rates by hundreds or even thousands of dollars, is a secret number you probably don't even know exists. A number that scores not just your driving but your entire life. It's called your credit-based insurance score. And no, it's not the same as the FICO score you use to get a mortgage or a credit card. It's a completely separate, 3-digit number, derived from the same raw data, your credit report, but processed through a different lens, a different algorithm, designed for one specific purpose: to predict how likely you are to file an insurance claim. To an insurer, this number is a crystal ball. It tells them more about your potential risk than your driving record, your age, or even the car you drive. Now, your first reaction might be the same as mine was. What on earth does my Visa bill have to do with how I drive my Honda? Feels unfair. Feels unrelated. And that's the heart of a massive, decades-long debate in the insurance industry. But to understand how comparison websites work, you have to understand the logic insurers use, whether you agree with it or not. Here's their argument. Decades ago, actuarial scientists at companies like FICO and LexisNexis started crunching massive amounts of data. They took millions of anonymous insurance records, people who filed claims, people who didn't, and cross-referenced them with millions of anonymous credit reports. And they found a statistical correlation that was so strong it was impossible to ignore. People who managed their finances responsibly also tended to manage their risk on the road responsibly. The data suggested that individuals with a history of on-time payments, low credit card balances, and a long stable credit history were statistically far less likely to get into accidents and file claims. Conversely, those with late payments, maxed out cards, and a history of collections were statistically more likely to cost the insurance company money. The correlation isn't about causation. A low score doesn't cause you to be a bad driver. Insurers will tell you it's simply a powerful statistical indicator of future behavior. They argue that a person who is meticulous about paying their bills on time is also more likely to be meticulous about getting their oil changed, replacing their tires, and obeying traffic laws. It's a proxy for conscientiousness. This discovery changed the entire industry. Suddenly, insurers had a new, incredibly powerful tool to price their risk. Your driving record shows your past. Your credit-based insurance score, they believe, predicts your future. But this practice is hugely controversial. Consumer advocacy groups argue that it's a discriminatory system that penalizes the poor, the recently divorced, young people without a long credit history, or anyone who has suffered a financial setback due to a medical emergency or job loss. They argue that your wealth or lack thereof shouldn't determine how much you pay for a legally mandated product like car insurance. How can a single missed payment from 5 years ago, because you were in the hospital, have any bearing on whether you'll run a red light tomorrow? It's a powerful and valid question. The pushback has been so strong that several states have taken action. California, Hawaii, and Massachusetts have banned the use of credit information in setting auto insurance rates altogether. In other states like Maryland and Utah, there are heavy restrictions on how it can be used. But in the vast majority of the United States, your credit-based insurance score is not just a factor. It's one of the most heavily weighted factors in your premium. So what exactly goes into this mysterious score? The formula is proprietary, a trade secret held by the companies that create them. But we know the key ingredients. First and foremost is your payment history. Do you pay your bills on time every time? This is the single biggest component. Second is your amount of outstanding debt, especially what's called your credit utilization ratio on revolving accounts like credit cards. If you have a $10,000 limit and you're carrying a $9,000 balance, that's a red flag. Third is the length of your credit history. A longer history of responsible use is always better. Fourth, the pursuit of new credit. If you've applied for 5 new credit cards in the last 6 months, it suggests financial instability. And finally, your credit mix. Having a healthy mix of different types of credit, like a mortgage, a car loan, and a credit card, and managing them all well, is seen as a positive sign. Just as important is what's not in the score. By law, they cannot use your race, color, religion, national origin, gender, or marital status. They can't use your age. They can't use your income, your job title, or your employment history. The algorithm only looks at the data within your credit report itself. The impact of this score is staggering. Let's imagine 2 30-year-old women, Sarah and Jessica. They live in the same apartment building in Dallas, Texas. They both drive a 2021 Toyota Camry. They both have a perfect driving record. No accidents, no tickets. On paper, they are identical insurance risks, but Sarah has an excellent credit-based insurance score. She's always paid her bills on time and keeps her credit card balances low. Jessica, on the other hand, went through a tough period a few years ago, missed a few payments, and has a higher debt load. When they both go to a comparison site like the Zebra, Sarah gets quotes starting at $90 a month. Jessica, the identical driver in every other way, gets quotes starting at $175 a month. That's an extra $1,000 a year. Not because she's a worse driver, but because an algorithm has flagged her financial history as a higher risk. This happens millions of times a day. It is the single biggest hidden factor in car insurance pricing. This brings us back to the comparison websites. How do they get this information? When you're filling out that form, your name, your address, your date of birth, you are giving them permission to access this data. Buried in the terms and conditions is an authorization for them, or their insurance partners, to perform what's called a soft pull on your credit report. This is a critical point. A soft pull is different from the hard pull that happens when you apply for a loan. A hard pull dings your credit score slightly. A soft pull, however, is invisible. It doesn't affect your FICO score at all. You can get 100 soft pulls a day, and your credit score won't budge. This is how comparison sites can give you an accurate, bindable quote without negatively impacting your credit. They run a soft pull, generate your credit-based insurance score behind the scenes, and feed that score into the pricing engines of dozens of different insurance carriers. Without this step, the quotes you'd get would be nothing more than a wild guess. This is why the sites that don't ask for as much personal information often give you vague estimates instead of real quotes. They're missing the most important ingredient. So what can you do about it? You can't just opt out, but you can take control. Improving your credit-based insurance score uses the exact same principles as improving your regular credit score. First, get a copy of your credit report and check it for errors. Simple mistakes can be costing you a fortune. Second, pay every single bill on time. Set up autopay if you have to. One late payment can linger on your report for 7 years. Third, focus on paying down high-balance credit cards. Try to keep your utilization below 30% of your total limit. And finally, avoid opening a lot of new accounts in a short period of time. Be patient and consistent. It won't change overnight, but over 6 to 12 months, these actions can dramatically improve your score and, in turn, slash your insurance premiums. You've now handed over every piece of your identity to this digital broker. your demographics, the specifics of your car, your driving history, and even a snapshot of your financial life. All these data points are now sitting in a computer, ready to be analyzed. But how does an algorithm take all of that and decide that for you? Geico should be number 1 on the list, while Progressive is number 5 and costs $400 more. The answer lies in the final, hidden layer of the system, the carrier's own secret sauce, and how comparison sites get a peek inside that highly protected black box. This black box is the insurance carrier's unique underwriting algorithm. Think of it as a secret recipe, a proprietary formula that is more closely guarded than the recipe for Coca-Cola. Every single insurance company, Geico, Progressive, State Farm, Allstate, you name it, has its own. And no two are alike. This recipe is the culmination of decades, sometimes over a century, of data analysis, actuarial science, and high-stakes business strategy. It's their competitive edge, the brain of their entire operation. When a comparison site like the Zebra gets your information, it doesn't try to guess what these companies will charge you. It doesn't run its own calculations. Instead, it acts as a universal translator and a high-speed messenger. It takes your standardized data, your age, your car, your address, your driving history, and securely packages it. Then, through a sophisticated piece of technology called an API, or Application Programming Interface, it sends that package directly to the front door of each insurance carrier's black box. Imagine the API as a fleet of digital messengers. In a matter of seconds, one messenger zips over to Progressive's headquarters, one to Geico's, one to Travelers, and so on for dozens of carriers. Each messenger hands over the exact same package of your information. This is critical. The data is identical for every carrier. What happens next is where the magic and the price difference comes from. Inside each company, your data is fed into their unique secret algorithm. And that algorithm starts asking 1,000 questions you never see. It's not just checking if you've had an accident. It's analyzing the type of accident. It's not just looking at your zip code. It's looking at the specific claims history for your city block. It's cross-referencing the make and model of your car with theft rates, repair costs, and even the statistical likelihood of that vehicle's driver profile to get into a collision. But it goes so much deeper than that. This is the part most people never realize. The algorithm isn't just calculating your individual risk. It's also factoring in the insurance company's own business goals for that specific quarter, in your specific state. Let's go back to our example. Why is a carrier like ClearCover $400 cheaper than Progressive for the exact same person? It could be that Progressive has recently paid out a huge number of claims in your state due to a hurricane or a series of hailstorms. Their algorithm is adjusted to be more cautious, to build back their reserves. So, they raise their rates, or more accurately, they become less competitive for new customers in that region. They're not as hungry for your business right now. Meanwhile, ClearCover might be a newer player trying to aggressively expand its market share in your state. Their board of directors has decided they're willing to take a smaller profit margin, or even a temporary loss, on new policies just to get more customers on the books. Their secret algorithm is programmed with this goal. It's designed to identify desirable customers, like you, and offer them a quote so good it's almost impossible to refuse. They are actively hunting for your business. So when you see that price difference, you're not just seeing a reflection of your driving record. You're seeing a snapshot of a massive, invisible chess game being played by billion-dollar corporations. You're seeing their risk tolerance, their market ambitions, their recent losses, and their future predictions, all distilled into a single number: your premium. One carrier's secret recipe might heavily favor homeowners, giving them a massive discount because their data shows homeowners are more stable and file fewer claims. Another carrier's recipe might not care about homeownership, but gives a huge price break to people with excellent credit-based insurance scores, in states where that's allowed. A third might have found a statistical correlation between certain professions and safer driving, offering a special rate for teachers or engineers. This is why brand loyalty in insurance can be so costly. The company that was the perfect fit for you last year, the one whose business goals and risk algorithm align perfectly with your profile, might have completely changed its strategy this year. They might have hit their growth target in your area and are no longer offering aggressive rates. Or maybe a competitor has just decided to target your exact demographic. The entire landscape shifts under your feet, silently, every 6 to 12 months. Without comparing, you'd never know you're no longer getting the best deal. You're paying for a strategy that no longer exists. So, how does the comparison site get these answers back so fast? The same way it sent them out, the API. Once the carrier's black box spits out a final bindable quote, It's handed back to that digital messenger. The messenger zips back to the comparison site, which then simply displays the price it was given. The site is a neutral platform. It's a stage, and each insurance company comes out and presents its best offer. The site's job is to get all the actors onto the stage at the same time so you can see them side by side. This process, from you hitting submit to seeing a list of real quotes, often takes less than a minute. In that minute, your data has securely traveled across the country, been analyzed by dozens of unique, multi-million-dollar algorithms, and the results have been sent all the way back to your screen. It's an incredible feat of technology designed to do one thing: cut through the noise. It cuts through the advertising, the jingles, and the mascots. It bypasses the need for you to spend hours on the phone or filling out the same form 10 different times on 10 different websites. It pierces the veil of the industry's complexity and gets straight to the only thing that really matters: the final number. Understanding this system fundamentally changes your relationship with insurance. You realize that your rate isn't a judgment on your character. It's a business proposition. And by using a comparison tool, you're turning the tables. You're not the one asking to be accepted by an insurer. You are the prize, and you are inviting them to bid for your business. You are creating a hyper-competitive marketplace in which you are the sole valued customer. The power of this is that it reveals the truth of the market in real time. It tells you who is hungriest for your business right now. The cheapest option on your screen is the company whose secret recipe, on this particular day for your particular profile, has decided that you are the most profitable, most desirable customer they could possibly acquire. So, the next time you see that list of quotes, remember what you're really looking at. You're not just seeing a list of prices. You're seeing the end result of a hidden, high-stakes battle of data and ambition. You're seeing the output of dozens of closely guarded secret formulas, each one representing a different strategy for navigating risk and seeking profit. And you're seeing the one piece of information that those companies don't necessarily want you to see: exactly how they stack up against each other. The system is designed to be opaque, to make you feel like the price is the price. But by pulling back the curtain, you see that it's a fluid, dynamic marketplace. And armed with that knowledge, you are no longer just a ratepayer. You are a market maker. You have the power to navigate this complex world, to bypass the loyalty trap, and to ensure you are always paying the best possible price for the coverage you need. The black box is no longer a mystery. It's a tool. And now you know exactly how to use it.